Now let's do some actual calculations for the federal income tax. A tax table is used to determine how much you owe based on your taxable income. However, you do not have to pay this much tax if you are entitled to any tax credits. Tax credits are sums of money that reduce the income tax owed by the full dollar for dollar amount of the credits. So in your book, there's always these little blitzer bonus sections, and this one I thought was nice to bring in. It says, a tax credit is not the same thing as a tax deduction. A tax deduction reduces taxable income, saving only a percentage of the deduction in taxes, whereas a tax credit reduces the income tax owed on the full dollar amount of the credit. There are credits available for everything from donating a kidney to buying a solar energy system. The American Opportunity Credit, included in the economic stimulus package of 2009, provided a tax credit for up to $2,500 per student. The credit can be used to lower the cost of the first 4 years of college. You can claim the credit for up to 100% of the first 2,000 in qualified college costs and 25% of the next 2,000. Significantly, 40% of this credit is refundable. This means that even if you do not have any taxable income, you could receive a check from the government for up to $1,000. Now, this was from 2009, so I'm not sure that this is still valid. Tax credits tend to change again from year to year. Sometimes there's tax credits for installing things like solar panels or upgrading to lower energy appliances and things like that. And then other years, they don't have those tax credits. So it really depends on a year-to-year basis. But what you want to know here is that when we do a deduction, right, we subtract that from our income to figure out our taxable income. And then what happens is you actually use tax tables with your taxable income to compute how much taxes you owe. A tax credit is different. So you still use those tables and compute how much taxes you owe, but you subtract the tax credit after that. So you get it as a total reduction, dollar for dollar amount in the amount of taxes that you owe. So they work a little bit different. A deduction kind of goes on the front end and reduces your income, whereas a tax credit goes on the back end and actually reduces the amount of tax owed at the end of the calculation. Couple of things to note is most people pay part or all of their tax bill during the year. So as I mentioned, when you have your taxes taken out of your paycheck, you're actually paying your tax bill for the year. And ideally, come April, when you file your taxes, you would have zero, meaning you owe nothing, you get nothing back. That's the ideal. Doesn't always work that way, but that's why you have taxes taken out of your paycheck so that you're not paying all of it at once in April. If you are employed, your employer deducts your federal taxes through withholdings based on a percentage of your gross pay. And if you're self-employed, what usually happens is you pay your tax bill through quarterly estimated taxes. So you would pay that directly to the IRS, usually through like an online website or something. When you file your tax return, as I mentioned, all you're really doing is settling up with the IRS over the amount of taxes you paid already during the year versus the federal income tax that you owe. So again, in April, they calculate officially what you should have paid in taxes for the previous year. They look at what you've already paid from your paycheck, and then they even it out. So if you paid too much, they give you some back. If you paid too little, then you owe more. When you pay too much, you get what's called a tax refund. Now, how do you actually calculate federal income tax? So first of all, you do need to find out your adjusted gross income and then your taxable income. And we've seen some examples on this already. So we got to find our taxable income first. Once we do that, we can figure out our income tax. So we use the tables to do our tax computation, and we'll do that together. It's a bit confusing. So we'll do that first. Again, they're typically done using tables, and a new table is published every year on the IRS website. So the one we're going to use is from 2016. I'm just going to use it to be consistent with the book, but I'll show you also the new updated numbers. And then once you have that, if you have tax credits, you would subtract it at the end. Okay. So let's go ahead and actually do an example here. And I think that will help kind of make this a little bit clearer on how we use these tables. Now, it's a little bit clearer in your text. If you're having trouble reading it, definitely go to the text. Again, these are from 2016. And you can see that it's kind of grouped here. So you have your single. You have people who are married who file separately. So if two people are married, they would file their separate own income taxes. Married and both partners file a single tax return, so that's called filing jointly. So what happens is that married couple puts their income sort of together. Like all the information is still separate, but they put it on one big tax return instead. And then you also have an idea of head of the household. So head of household, this would be unmarried and paying more than half of the cost of supporting a child or parent. So those would be like if you are a single parent, so if you are unmarried and you pay more than half of the costs to maintain that household. So theoretically, if you were a single parent, right, you'd probably pay the whole thing. So you would be under head of household. So it's a sort of a different designation for single. If you're a single person that's just paying for yourself, that's different. So head of household is that you are supporting other people, so children or a parent, etc. So you have these 4 different kind of designations here. And then you can see that it's broken down by tax rate. Now, what happens is when we do our calculation, it's a sort of a climbing tax rate in the sense that when we find our income, let's say your income is, let's say you're single and your income falls at $200,000. So you make a lot of money and you make $200,000 in taxable income, which falls in between 190 and 413. Well, you don't just pay 33%, you actually have to build through the groups. So you pay 10% on your first 9,000, you pay 15% on the next group from the amount that you make between 9,000 and 37,000. You pay 25% on the next group, 28% on the next one, and 33. So it builds through. It's not just a straight 33 calculation. So again, it can get kind of tricky. So let's do an example here. All right. So we're going to calculate the federal income tax owed by a single woman with no dependents whose gross income adjustments, deductions, and credits are given below. And we're going to use the 2006 marginal tax rates here again, just to be consistent with your book. So her gross income is $62,000. We have her adjustments and we have her deductions. So the first thing I need to figure out, I'm just going to go in order here. So we know her gross income. We're already told that is $62,000. So I need her adjusted gross income. So I'm going to take her gross income and subtract any adjustments. So we have that $62,000 and we have this $4,000 adjustment. So once we do that, we're left with $58,000. So next I need to do her taxable income. So again, I take her adjusted gross income and I'm going to subtract any sort of exemptions and deductions. So let's see, we're starting with 58,000 now, and we're going to subtract out. All right, so for deductions here, she has 7,500 in mortgage interest, 2,200 property taxes, 24,000 charitable contributions, and then 1,500 in medical expenses not covered by insurance. So one thing to note here is that your standard deduction is usually not this much. So the option here for standard deduction wasn't even given. You can see her mortgage interest is very high already, so it's likely that she would not take the standard deduction. But you would still double check. So it's not offered here, so I'm not going to worry about it, but you want to make sure that your itemized deductions and your standard deduction are, pick the one that's highest, right? So you save the most money here. Now, one thing I want to note with medical expenses is this amount has to be over 7.5% of your adjusted gross income. So 7.5% times her adjusted gross income of 58,000. Now remember, when you're doing your percents, we got to use the decimal form. Okay, is 4,350. So she only had $1,500 in medical expenses not covered by insurance, so out of pocket. And you would think that's a lot, but based on her income, it would need to be expenses over 4,350 out of pocket for her to actually be able to claim it on her tax return. So it sounds like you can often use medical expenses, but most of the time you can't unless you really, really have a significant amount. I know even for myself, I had a lot of dental expenses one year, and I thought for sure I'd be able to write it off, and I still wasn't high enough. So you can see that it's quite a high threshold to hit for medical expenses to usually actually be able to deduct it. So what I have here instead, where I have all my values. Let's see. So I have, let me do these separately first. 7,500 for the mortgage interest, 2,200 for property taxes, and 2,400 for charitable contributions. Tax credits do not get included right now. They get included at the end. Okay. Now, let's see. I didn't put this in here in this problem, but it was already stated. So let me just clarify here that they did mention that there is a standard exemption here of $4,050 for that year for 2016. So I am going to add that in as well. So that would be the exemption. And again, it wasn't really restated in this problem here, but if you read through the material for this unit, it did say a few times that for 2016, we're using a standard exemption of $4,050. So I think it said $4,050. So we're actually going to include that as well here. All right, so I think I have all my numbers now. So I'm going to subtract out these values all together. So I'm subtracting out $16,150. And finally, I get $41,850 for this person's taxable income. Now that's only the first step here. I'm not done yet. Okay, so I have to do some more work. All right, so now that we have our taxable income, we're actually able to calculate that federal income tax here using the table. So like I said, this is quite a lot of work to do by hand, but we can definitely do it. So I'm going to use a different color. Let's use blue. So the value we're going to use when doing our federal income tax using the tables here is her taxable income amount, so the $41,850. So you can see, she started with $62,000 for her gross income, but because we have so many deductions and exemptions and adjustments, her taxable income is only $41,850. So it definitely lowers how much she's going to pay in taxes. Now, she is single, so because we're single, we're going to be using this first column here. And she makes $41,850 in her taxable income. So that 41,000, look, we see that it falls in this group here, right? It's between 37,000 and 91,000. So she's in here. Now, it's not just a straight 25% of 41,850. We actually have to build through the table. So notice that, let's use different colors. Notice that we pay 10% on the first $9,275. So she's going to pay 10% for the first $9,275 she made that year. So it's going to be 0.10 times that $9,275. So we get $927.50 for that first amount. Okay. But she made more than $9,000, right? She definitely did. She made $41,000 in taxable income. So we're going to go back up here. And now we're going to look at the next group. So she pays 15% on any money from $9,276 to $37,650. Okay. Now you want to be careful here. It's not just 15,000 times 15%, sorry, times that 37,000. It's really like very similar to a percent increase or decrease problem where you have to find that change amount here. So if I look at this group here, that range of values is from 37,650 down to 9,276. Now, if I subtract these, 9,070, 75, because you have to use this value right here. And then when I subtract, I get 28,375. So this little group in here has a value of $28,375. And that's because she's already paid taxes on the first $9,275 that she made. We're not going to have her pay taxes again on that amount. So now you're starting at the 9,276 and going up to 37,650. She's over the 37,650, right? She's done that. She's way over that. She's at 41,000. So we have to include everything in between here. So the amount of money in between these two values from this row to this row is 28,375. So that's how much she pays 15% on. Okay. All right. So we get 4,000. See, $256.25. So she's at 41,850. We got to keep going. Now this brings us to the last category. Now we want to be careful here because she only has a taxable income of around 41,000. This group goes up to 91,000. So we're not going to tax her on the whole group because she doesn't make that much. She doesn't make the 91,000. In the last category, it was different because she was over the 37,000, so we had to tax her on the whole group. Here, she only makes that 48,000 or 41,000, so we're too high. So what we do here is we take her final amount, which is 41,850, and we subtract what she's already paid. She's already paid taxes on that 37,650, right? So what I have left over here is just $4,200 that she hasn't paid taxes on, right? Because we've already charged her for the first 9,000, then we charged her for the next 37,000, and now we have to charge her up until that 41,850. So there's $4,200 left, and this group is at 25%. Okay. So I get $1,050.00. And finally, when I add those all up together, so add that whole group up, I'm going to get $6,233.75. Okay, so we're almost done here. So basically, this person should have paid about $6,233.75 in federal tax for the year. However, she does have a tax credit. So she has a tax credit of $500. So I'm not sure where it came from. Maybe she did something like install solar panels, or she had an educational tax credit, whatever it was for, or a child tax credit. So that's going to get subtracted at the end. So once we're done, 500, sorry, no. We're going to subtract out our tax credit. So finally, we get 5,733.75. So this is what this person's federal income tax would be for the year. Okay, so now she's already had taxes taken out for the year, right, out of her paycheck. So if she paid more than $5,733.75, she would get a refund in April. If she paid less than that, then she would get a bill in April. So she'd have to make up the difference, right? So this is how much you would pay. All right, now before we go on, let's see. I do wanted to share with you some updated information, so give me 1 minute. Page. Okay. Okay. So here, if you're interested, I did go to the IRS website, and I just did some searching, and you can find the new values for the current year. So we're in 2021, which means people are, when this video is recorded, it's 2021. So people are doing their taxes for 2020, but you can do this each year. So they do get adjusted every single year. And if you scroll down, and you can find a table form too, but you can see they have the different marginal tax rates, and they have the different levels as well. So this one is for married couples filing jointly, for instance. So they do get adjusted throughout the years, right? So they do change from year to year. often. So you do want to kind of make sure you have the most accurate ones. If you're doing your taxes online or something like that, you know, a lot of technology does all this for you, so you don't have to do it by hand anymore. But just kind of, I wanted to point out that they do change, right? So you have information here about the standard deduction for filing jointly. You have information here about the different tax breakdowns, and so on. And this is just one page of information. So these numbers do change from year to year, and it's just something to be aware of. So as you're doing your homework, your book is really focusing on the 2016 information, but obviously this would be updated from year to year.